Hi there, I had to walk into this coming week, starting from scratch. Knowing what I know about earnings, AI spending, oil risk, and the way this market is sitting near record highs, I would not treat this like a normal week. Most people think earnings season is about whether a company beats the number analysts expected, but that is not what this is about anymore. We are in a market where the biggest companies are carrying the mood, where AI has become the engine, and where one sentence on a conference call can move the whole tape before regular investors even understand what changed. Today is Sunday, April 26, New York time. Comment what day and date you are watching from, because this week could look very different depending on when this video reaches you. And if you value this kind of market breakdown, support the channel by subscribing and comment John A.G. Best below. It tells me you want the roadmap before the crowd starts panicking. So in this video, we are going to walk through exactly why this week matters. Not because every stock is suddenly dangerous, not because the market must crash, but because expectations are so high now that good news may need to be great news, and great news may still need guidance that sounds almost perfect. That is the setup. The market has been climbing. The big indexes have been pushing into fresh high ground. AI names have been pulling money like a magnet. Semiconductor stocks, data center stocks, power names, cloud companies. The whole thing has turned into one giant question. Is this a real earnings boom, or is the market paying today for profits that still have to show up tomorrow? That is where people get hurt. A strong market and a safe market are not the same thing. You can have a market that looks powerful on the outside while underneath. Investors are quietly buying protection, software names are cracking, energy prices are keeping traders nervous, and companies with decent numbers are still getting punished because the future story is not clean enough. Let's get started. The first thing to understand is that this is not just another earnings week. It is a confidence test. A huge share of the S&P 500 is reporting, and it is not spread out gently. It is stacked. It is compressed. It is sitting right next to major economic data, the Federal Reserve, and one of the most important mega-cap tech clusters we have seen this year. Microsoft, Alphabet, Meta, Amazon, Apple. That is not just a watch list. That is the control room. When names like that report close together, the question is not simply, did they beat earnings? The real question is, did they beat by enough to justify the prices investors already paid? Because when stocks run before the report, the market is not asking for average. It is asking for proof. Based on recent earnings updates, the broader market is still expected to show solid profit growth, somewhere in the mid-teens. And a large wave of companies is due to report in the same window. That sounds bullish, and maybe it is. But it also raises the bar. When everyone already expects strength, strength alone does not surprise anyone. That is why guidance matters more than the headline beat. The beat tells you what just happened. Guidance tells you whether the story is still alive. And in this market, guidance is everything. Look at what happened recently. Some companies delivered fine results and still got sold because the outlook was not exciting enough. Others were rewarded because investors saw real demand, real margins, and a believable path forward. That is the market telling you the rules have changed. You do not get paid for saying AI anymore. You get paid for showing what AI is doing to revenue, margins, customer demand, and cash flow. That is the first major theme this week. AI monetization. A year or two ago, all a company had to do was mention AI, automation, productivity, and the stock could catch a bid. That phase is over. Now investors want receipts. They want to know whether the spending is turning into actual business. They want to know whether customers are renewing, upgrading, and paying more. They want to know whether AI is a profit center or just a very expensive science project wearing a fancy suit. Microsoft is probably the cleanest test of that. Not because it is the only AI company, but because it sits at the intersection of cloud, enterprise software, AI tools, and corporate budgets. If cloud growth stays strong and AI tools show real adoption, that supports the whole AI trade. If the tone gets soft, a lot of investors are going to start looking at their exposure and wondering how much of the future they already paid for. Alphabet has a different problem. Search is still one of the greatest businesses ever built, but AI changes the way people ask questions and receive answers. Maybe that improves engagement. Maybe it opens new ad formats. Maybe it strengthens the ecosystem. But maybe it pressures margins and changes user behavior in a way the old model was not built for. That is the risk, and markets do not wait for perfect clarity. They reprice uncertainty first and ask questions later. Meta is another test. The advertising machine can still be powerful, and AI can make ad targeting sharper. But investors will watch spending, AI infrastructure, and the losses attached to future bets. The market loves innovation when profit is expanding. It gets much less patient when the spending line starts growing faster than confidence. And Apple, well, Apple is Apple. It does not need to be the loudest AI story to move the market. It sits in indexes, retirement accounts, funds, and portfolios everywhere. Investors will listen for demand, China, services, margins, and whether the brand still has the same pricing power in a world where consumers are becoming more selective. That brings us to the second theme, the consumer. Everyone wants to talk about chips, and I understand why. Chips are the obvious bottleneck, but the consumer is still the floor under the economy. If the consumer holds, earnings can stay supported. If the consumer weakens, the market multiple can shrink quickly, even if AI remains a long-term story. This is why travel, restaurants, phones, coffee, advertising, and credit behavior all matter. They are not random pieces. They are windows into whether households are still spending freely or quietly pulling back. American Airlines gave us a useful example. Revenue hit a record for the first quarter, so demand did not disappear. People are still traveling. But fuel costs are a serious problem, and management had to lower the full-year profit outlook because jet fuel pressure is eating into the story. That is the kind of split market we are in. Demand can look strong and margins can still get squeezed. That is why oil matters. Oil is the risk that does not need permission from earnings season. It just walks into the room. With the Strait of Hormuz situation still creating concern and energy forecasts carrying a risk premium, the market is dealing with a problem that goes beyond one sector. Higher oil can pressure airlines. It can pressure consumers. It can complicate inflation. It can make the Fed's job harder. And if energy stays high long enough, it can change how investors value future earnings. Now, I am not saying oil automatically breaks the market. That would be too simple. Markets can climb through scary headlines when earnings are strong and liquidity is supportive. But high valuations plus high expectations plus oil risk is not calm. It is spring-loaded. The third theme is market risk, not crash risk, not doomsday, just risk. There is a difference. A market can be bullish and fragile at the same time. That is what people miss. When leadership is concentrated in mega-cap tech and AI-linked names, the indexes can look healthy while the average stock is doing something very different. You can have strength in semiconductors, industrial chips, and data center power plays, while software companies are warning you that corporate buyers are getting more careful. That split is important. Texas Instruments showed the good side of the split. Strong demand tied to industrial, automotive, and data center customers helped the stock because investors saw a real business cycle improving. That matters because it suggests the AI build-out is not only about the flashy front end. It is also about analog chips, power management, and equipment that makes the physical system work. IBM and ServiceNow showed the other side. Both carried AI narratives, but investors focused on slower software growth, deal delays, margin questions, and fears that AI may disrupt some traditional software economics. That is a big deal. It means AI is not just lifting technology. It is also separating winners from companies that may be vulnerable to the very tools everyone is celebrating. That is the uncomfortable part. AI is not a blanket. It does not warm everyone equally. For some companies, it creates demand. For others, it creates competition. For some, it improves margins. For others, it forces spending just to stay relevant. And this is why the data center story is so important. People talk about AI like it lives in the air. It does not. It lives in buildings filled with chips, cooling systems, power equipment, fiber, backup generation, transformers, and land. The digital world has a very physical backbone. As AI demand grows, the market is not just buying software. It is buying electricity, infrastructure, and capacity. Recent energy research shows data centers could become a much larger share of U.S. electricity use by the end of the decade, potentially moving from a small share today toward a high single-digit or even low double-digit share in some estimates. That is not a tiny adjustment. That is a planning problem for utilities, grid operators, and anyone trying to build AI capacity at scale. This is why investors are watching data center funds, semiconductor funds, power equipment companies, and energy infrastructure names. Not because every one of them will win, many will not, but because the bottleneck has moved. The question is no longer just who has the best model, it is also who can power the model. Now here is the counterpoint. Just because the theme is real does not mean every stock tied to the theme is cheap. That is where people confuse a great story with a great entry. AI demand can be real. Data center power demand can be real. Cloud spending can be real. And a stock can still be priced like everything goes perfectly. If anything comes in merely okay, the stock can fall. That is not manipulation, that is valuation. So what do you actually watch this week? First, watch the reaction, not just the result. If a company beats and sells off, the market is telling you the future was already priced in. If a company misses and rallies, the guidance probably mattered more than the past. Second, listen for capital spending. Big tech spending is now one of the most important signals in the entire AI supply chain. If hyperscalers keep spending aggressively, chip makers, power providers, data centers, and infrastructure names can benefit. If they slow down, the entire AI equipment trade may need to reset. Third, watch the language around customers. Are customers accelerating deployments, or are they testing slowly? Are they expanding budgets or shifting budgets? Are deals closing or getting delayed? Fourth, watch margins. Revenue growth is nice, but if the cost of building AI rises faster than the money coming in, investors will start asking harder questions. Fifth, watch oil and the Fed. The coming week is not only earnings, it also brings major economic data and a central bank decision. If inflation signals stay hot while oil remains elevated, the market may have to rethink how easy policy can become. One more thing here. Liquidity matters. When investors feel like the Fed is trapped between inflation and growth, every sentence from policymakers becomes part of the earnings reaction. A great report can get muted if rates look tighter for longer. A mediocre report can get saved if investors think policy will become easier. That is why the same earnings number can create two totally different stock moves in two different macro environments. The company did not change. The discount rate changed. And in a market built on long-duration growth stories, that matters more than people want to admit. Keep one eye on execution and the other eye on what investors are still willing to pay for it. If you are successful, share your success story in the comments so others can stay motivated. The bottom line is simple. This week is not important because one company reports. It is important because several market pillars are being tested at the same time. AI has to prove it is becoming money. Mega cap tech has to defend premium valuations. Consumers have to show they are still spending. Energy risk has to stay contained. The Fed has to avoid spooking investors, and the market has to digest all of it while sitting near highs. That is a lot to ask from 1 week. Could it work? Absolutely. If the biggest companies show strong demand, disciplined spending, healthy margins, and confident guidance, the rally can continue. Record highs alone are not bearish. In real bull markets, record highs can keep leading to more record highs. But if the reports show that AI spending is massive while returns are still distant, or if consumer cracks widen, or if oil keeps pressure on margins, then the market may suddenly remember that price matters. So do not go into this week asleep. Know what you own. Understand where your exposure really is. If you own index funds, growth funds, tech funds, retirement accounts, and individual mega-cap stocks, you may have more of the same trade than you realize. And do not let one dramatic candle make your decision for you. Earnings week is designed to mess with your emotions. Big green candles make you feel late. Big red candles make you feel wrong. Neither feeling is a plan. The market is going to talk this week. The key is to listen to the right part. Not the headline, the guidance, not the hype, the cash flow, not the promise, the proof. That is the difference between chasing the story and understanding the setup. And as always, nothing here is personal financial advice. This is educational market commentary, meant to help you think through risk, earnings, and positioning with a clearer head. Your money, your timeline, your responsibility. Make the decision that fits your own situation, not the noise of the week.